Hey everybody, welcome. I'm live here with Geoff Black with Gilda Mortgage, and he's a loan officer that we've been working with, for a number of years. And today we are going to be talking about how can you actually buy a home in today's market and how to make it work, so that you can have some tips and tricks. And we're excited to talk with him today. So, Geoff, let me see if this is still working. Hold on. We're excited to. Okay, sorry, I think it is. So let's start off with the biggest misconception that you feel like buyers have right now about buying. And before that, you can start off and tell us a little bit about yourself. So I'm jumping ahead.
Geoff Black. I've been a mortgage lender since 2002. Um, and I'm a creature of habit. I've been with the same continuous organization since 2003. So that's what, when recruiters call, that's what I say. Um, Seeing, hundreds and hundreds and hundreds of transactions and scenarios in different environments and different markets and different cycles. That's really about it. Um, as far as misconceptions, well, biggest misconception for buyers right now, a lot of it is just getting started. And, when I chat with them, the easy things are, they feel like they need a certain down payment. That's very common. Some feel like they have to have, their credit has to be absolutely completely perfect. And the definition of perfect is, in their mind, is like an 810 FICO score. And, the reality is that a person can get a mortgage with a 600 or under in certain circumstances. And the other reality is, 720 and 740 are generally like the most optimized credit score anyway. And anything over that is extra credit. That's what I tell clients anyway. What they're really gaining from being north of 720 is a discount on the mortgage insurance by a few dollars. And when I show them the contrast, it's not a large meaningful amount in comparison to the whole thing. So that comes up a lot. And then, as far as the other one is where they source their down payment from. There's a lot of people out there that still think that getting a gift from family is somehow, circumventing the tax system, or there's something wrong with it, which is always interesting. When 40% of first-time buyers are getting family assistance in the form of a gift.
Wow. Okay, 40% of buyers right now are getting down payment in the form of a gift.
Roughly 39% of first-time buyers on a national basis are getting some form of family assistance. And
Got it. I feel like the audio is still kind of challenging a little bit.
Sorry.
I know, maybe your mic. It's not bad, or maybe just talk a little louder.
I can. Yes. I'm just turning up the volume a little bit. Does that help?
Maybe a little bit.
You're louder, that's for sure.
Okay, we'll just keep going.
Yeah, sorry. Anyway, but gifting is, definitely with first-time buyers, it's actually uncommon for me to see a first-time buyer that's not getting some sort of a gift, some form of assistance, and that can be a few $1,000s, and it could be, the entire down payment. So it varies.
Yeah, we just had that happen too with one of our clients. And I think it happened with us when my husband bought his first condo. That was, his parents helped. And without that, we wouldn't have been able to move into that or buy our next house, or, you have to start somewhere. So I think, yeah, buyers being willing to take on that gift if they have it is one way to get them into the market right now.
Right. Definitely it's an access point for sure. And I think a lot more parents seem willing, years. You've seen headlines that the transfer of wealth or the transfer, and it seems to be out. But of course, we're in California where the home prices are a little higher, and therefore the down payments are a little bigger, and so it makes some sense. I wonder what I can't speak for what it's like in other states that are lower cost.
Yeah. Yeah. Okay. Thanks for sharing that. And what on your end, what price range is still really competitive right now?
700 grand. It's just
Okay.
it's 700 grand, and it doesn't seem to change, and it's been that way for a long time. Um, you know, just in casual observation of the market, at $500,000 or 600,000 or 4 to 600,000, let's say, as a percentage, there are more people that qualify for that home. They're it's in the wheelhouse for a lot more, a higher percentage of folks. But interestingly, I've noticed that at around 675 to 750 is where that's the sweet spot for the dual income professional that has a little bit of savings, and they have the ability to handle the payment, and that gets them into a house that's desirable enough to bring forth their motivation. It's in a $700,000 home puts you in a neighborhood that they want to be in, or that they imagine they want to be in, and so that's the driver. But if something comes up and it's 750 and it's appropriate for the area, and it's in reasonably good condition, there just seems to be a lot of bids on it.
Yeah. Yeah. I know we're noticing 5 to 650. We had one client and they made the best offer they could, and there were 10 offers, and unfortunately they didn't get it because the other buyer waived contingencies. And it's like, yeah, it was I think 650-ish with a pool and really nice kitchen. So it is hard, yeah, when there's so much competition, but there's ways that we can structure the offers to try to make them more competitive, with our clients. And
Yeah, to be competitive, I mean, everybody's offering some degree of speed. If that's what's needed, and that's what would entice the seller to entertain the offer, speed. Um, I have, appraisal contingencies are being lifted often. On the other side of it, almost 50% of the transactions I've done this year have had an appraisal waiver and haven't even required one, which is
can you
interesting.
explain that to people who don't understand what that is?
An appraisal waiver is when we get a loan, when we set it up, we run it through Fannie Mae and Freddie Mac's online software that underwrites the file. It's a preliminary underwriting. And when we have an address and we put it in there and it's a live transaction, it will spit back to us whether or not an appraisal is required for that transaction, which is different slightly than when a buyer elects to waive their appraisal contingency. But nonetheless, you know, I've seen it with a lot of 20% down. Obviously, with the FHA and VA, it's not possible. Most recent VA transaction, they had a down payment and they were using VA, which is kind of a rarity, and they waived their appraisal contingency. And you can't get an appraisal waiver on VA or FHA. But a lot of times, I'll set up the transaction. They've just gone through bidding often, and set up the transaction the next morning. Hey, we don't need an appraisal at all. And if they've waived their appraisal contingency, it's a huge relief to them because they don't have to worry about the possibility of an appraisal coming in low and there being a shortfall, or them having to reconfigure the transaction to accommodate that. So it's been nice this year from that standpoint. And I think the reason for that is prices are fairly stable. They're just growing at a fairly natural rate. There hasn't been a huge jump from last year to this year when the system can't pick up on that. When we don't get waivers, or when we started seeing fewer of them, is when prices were just going through the roof, right? The algorithm just couldn't forecast. It couldn't read that. It'd be like, it's just reaching too far forward. And appraisers have the same problem when prices are escalating very rapidly. the comps in the rear view they can't stretch the value to the new price. They just can't get that far. I'm not saying it's not worth it. They just can't back it up.
Yeah, yeah.
Anyway, but the waivers, I mean, and of course they're more efficient. It saves money in the transaction. You know, prices are $700, and it's a milestone. The first thing we do when we set up a transaction is order the appraisal and set up the file in the background, and we're waiting for the appraisal to come back in order to go to the next milestone in many cases. So having a waiver just removes efficiency.
Got it. Okay, thanks for sharing that. And do you feel like buyers are waiting too long, hoping that rates will drop right now? Buyers that are sitting on the fence?
You know, unfortunately, I think a lot of buyers, because of where rates and prices are, I mean, you know, the overall payment is higher in the last few years, and a lot there's, I think that's created a lot of hesitancy, and the translation is they're waiting for rates to come down, but really they're waiting for the home to become more affordable. And you know, not the people that have come forward this year and last year, when they come forward to me and they're applying, they're like they want to buy a house. They're not trying to time the market. They've already made the decision that the environment is what it is, and they've accepted that, you know, they've accepted that. Obviously, when rates fall, buyer demand can respond very quickly to that, right? So, you know, like last fall when rates were falling, people became more confident, and so more people came forward to have the conversation to see if they qualified. There's tons of people out there that certainly qualify, but they're hesitant because the payment, you know, the cost relative to the rent, you know, could be vastly different.
Yeah, that's a good point. You said they're waiting for rates to come down. That's what they say, but you said like they know they want to buy, but they're really waiting for is for that payment to become more affordable.
Yeah, I mean, the falling rates gives buyers confidence to come forward. That's what I think. And
Yeah.
when, you know, so there is a subset of people out there, I think, that definitely can buy. They're not even coming forward at all. You know, so
Right.
they're in that sense they are waiting, right? Um, and the people that are coming forward are definitely need based. You know, there's a baby coming, there's a divorce happening, someone passed away, someone's relocating. Um, you know, this year I've noticed, you know, I've done a lot of first time buyers and a lot of, I guess, replacement home buyers. They're not moving up. They're empty nesters, want to be closer to family. I'm like 6 of those so far. Um, and but the person that's in the home right now, and you know, their payment's $1,800, and they bought it in 2017. Those people, they look at the numbers and they're like, geez, I don't know. But a lot of, you know, if they came forward and had a conversation, at least they would get verification of what it really costs. I think a lot of those people are just sort of imagining that it's going to cost so much more, you know, and you know, so they don't have the motivation to come forward.
Yeah.
So
They're chat
that's
GPT in it.
when I see rate hesitancy, you know, or that term like that, I think of the lock-in effect, which is often talked about, which is someone with a low rate that's reluctant to move.
Yeah, yeah. And there has to be a big enough change, right? Like we would love to have a 5 bedroom, and when we see the 5 bedrooms that come on the market and how much they are and how much work we'd have to put into it, and then the payment that goes with that, it's like it's not a big enough move up for us to make that write that check, if you will. So I think it depends. But if we weren't already in this neighborhood that we liked, maybe we would, there might be a different, if
You're
your
content.
motivation's high enough, then you might be willing to do what it takes. But
Yeah.
um,
And the first time buyers, they're accepting the reality of the market because it's what they're faced with. It's different. They
mhm,
don't have that reference point of,
right.
golly, my first home was X or whatever.
Yes.
Um,
And
they
sometimes
are,
I think you have to start in that, like we tell clients, like you may have to start in your, not in your dream neighborhood. Like you might have to start somewhere and then move up along the way. But sometimes I think people have this idea of what they think their first home is going to be like. And to afford that, the numbers don't match up.
yeah, there's a self-talk out there that, where people have this notion that the only way they can justify the expense or the responsibility of owning a home is that only if they get what they want, like
Mhm.
their final home. And so the stepping stone methodology sort of gets lost in that internal dialogue, I think. My first
Yeah.
home was $70,000 and I couldn't afford to pay for a lawnmower for 6 months. I tell that story all the time.
You just
But
aged yourself, so
I know, well,
congratulations.
it was also in Idaho. It was cheap. But like, I don't know. And it was, that first home was, it was fine. It wasn't unsafe or anything like that. It was just small, modest, you know, and it was in the wheelhouse and it was, it's fine.
Yeah, yeah. Well, and yeah, you have to start somewhere. And I tell people, like, if you think of different, like, I think of my grandparents who lived in their house for 50 years, or, and those were smaller 1,500 square foot homes that they just lived in their whole life. They didn't keep moving. But
Right.
okay, let's move on to credit. So, right now, what do you feel like is hurting people's credit the most right now when you're
Car
talking to
payments.
buyers? What is it?
Car payments.
Okay.
It's not hurting their credit. It's hurting their hurting is relative too, but like it's definitely taking a bite out of their maximum purchasing power. And a lot of people are aware of this because car payments have gotten so expensive. I think the median car payment is like $750 or something like that. And that $750 is $110,000 worth of purchasing power. If you took that same debt and allocated it towards a mortgage, that's meaningful. That's someone coming forward and they qualify for $600,000, except they just bought a new car and the payment, let's just assume it's $700 a month. They could be looking at a $700 home, but at the same time, people have to be able to get to work. And
Right.
you know, um, there's a lot of people pushing car purchases back because they're so expensive. But
Right.
definitely, car payments jump off the credit report. Like they just
Yeah, yeah. It's good to equate the payment to how much you lose in purchasing power. So $700 a month car payment, you lose about 100K in
110. Yeah, I mean,
110,000 in purchasing power.
that's
I think it's good to,
roundabout.
yeah,
It's probably slightly more than that, but depending upon visiting factors, that's pretty fair. 650 to 725 is about 100.
got it. Well, I think it's helpful to see that. That way you know when you're considering buying a car, when you want to get into a house. And then what do you feel like as far as buyers wanting to pay off debt before buying or keep cash in the bank? If somebody's toying with that idea, what would your advice be?
That's very subjective. It just really depends upon what their total cash position is and whether or not clearing those debts is going to improve. And that's one of the things we do. When we have someone come forward, first time buyer, I'm saying I have this money in this one hand and I have this debt that I'd like to clear out in the other. We'll look at, does it, if they clear out the debt, does it benefit their credit score? Would that enhance their borrowing power? Um, or, do they need, every dime to achieve the purchase that they're after? I mean, that one is very subjective. I'm a big fan of having cash, which gives freedom. So generally speaking, given between those two choices, I'll say, you know, leave the debts alone for now. If they're modest, they're just annoying. Let's say they're not burdensome, they're annoying. Let's leave the debts alone. Let's get you through the purchase. And keep in mind that we want to be as cost efficient or cash efficient as possible with the purchase so that when the dust settles, you could have the option of reducing that debt. I mean, it really is super subjective because if you have someone come forward that has like $50,000 in consumer debt and they have $100,000 saved and their credit score is flagging under the weight of the debt, some reconfiguring needs to happen. And that's where we'll use software for that, to optimize the score, see where the money goes furthest. And then of course we'll be looking at paying off which debt gives you the biggest bang for the buck on payment relief, right? Because you can have $20,000 debt in some circumstances where the payment is like the minimum payment is $100 a month, and you could have a $7,000 debt where the minimum payment is $200 a month. So you got to weigh out which of those choices makes the most sense to achieve the goal of getting into the house.
Yeah, makes sense. When you can help them with all that, you can help people
No, that's what
run
we
the
do all the
scenarios.
time. We do it all
Perfect.
the time.
Now let's talk about down payments a little bit. So what's the minimum down payment that somebody needs to get into a house?
I mean, technically, it's zero. I mean, there are programs out there you can get into a house with no money down, but there's always an offset for that. You know, the a lot of the first time buyer programs that are available in the marketplace right now are programs that give you access to homeownership if you don't have a down payment. So if you have reasonable credit, reasonable income, but you just don't have the down payment and you're motivated to buy a house, you can do that. There's a cost associated with that. It's not huge, but it's a little bit more than if you did have a down payment. The most common is, to me, 10% down is the promised land. That's the sweet spot where the value of what your payment is, the interest rate, the mortgage insurance, everything settles down and gets a little more cost effective. And then of course, FHA is very useful with 3.5% down. You can do a 3% down loan with conventional financing. That's been available for a long time. And in comparison to a no money down, it's a little cheaper. With each increment, it gets a little more cost efficient. As far as your borrowed dollar goes a little further, and the closing costs become a little more manageable. Not to say that with no money down they're outrageous, and not to say that with 20% down they become free. It's just just layers down a little bit.
Yeah. Okay, so if we ran a scenario like at 600,000, if I'm going to put no money down, that doesn't necessarily mean I don't have to, I have no out-of-pocket costs through the closing.
Correct. Yeah. So you still. So if for example a person were wanting to spend $600,000 and they wanted no money down, which is no down payment, in certain circumstances you can get a no down payment loan, and you can get other another product that will help you with some of the closing costs. But walking into the house with $0 out of pocket is difficult to set up. It's not a realistic approach because I guess one could say it's like, I'm going to do no money down, I'm going to get a little closing cost assistance, and then I'm also going to get a seller credit to just cover everything else. And so hypothetically, you could design a transaction that would achieve that. In practical matters, it's the likelihood that they would qualify for the closing cost assistance piece of the CalHFA product, and or find a seller that's willing to participate. These things are possible, but they're rare.
Yeah. Yeah.
So a
And in
more
that
realistic,
competitive, oh, go ahead.
well, yeah, and in a kind of competitive price point, it's difficult enough, on its own. But I guess my point is, it would be more realistic to say it could be done with no down payment. These are the costs associated with that. But these are the closing costs associated with it, and this is what you would need to come up with instead of coming up with down payment and closing costs. It's just closing costs.
Yeah. Yeah. And yeah, getting that seller credit in a competitive market in that 600,000 range, that's hard when you're competing against multiple offers. That's like the first thing you don't do. I mean, you still can, but if you want the most competitive offer, you're going to be asking the seller for less things so that you can stand out against the competition.
Exactly. Yeah, I mean, like I said, in theory, are the products available? Can they do? Yeah, absolutely. Do they exist? I mean, you apply them to market forces, it becomes a little more difficult.
Yeah. Yeah. All right. What is the most creative deal structure that you've recently helped someone with,
Oh, geez.
or a success story that you want to share with our audience?
Probably this one. Clients I've worked with since 2015, 2014, something like that. Helped them buy their house, kept in touch with them over the years, helped them with refinances. They decided they wanted to move from the suburbs to central downtown. And they wrote, this is this spring, they wrote 5 offers, and they were going through what I refer to as casually as the hazing process of trying to buy in a high demand area. They were going after the beautiful, perfect properties in the 800 to $1 million range. They had 40% down payment. They come across very strong. They were coming in over asking, and they were just getting clobbered. And finally, I intervened as between offers and just said, hey, are you guys waiving your appraisal contingency? And they said, well, no. I said, oh, okay. You might consider it. Explain that to them. And then an agent they're working with doesn't work the market area that they were offering in. And just through luck, they put together this package on this offer, waived the appraisal contingency because with 40% down, the risk there is very low. And I knew the listing agent from being around for a while, called, put in a good word, moved our name to the top of the list. We got the final counter. They're closing next week. That was one of the 5 offers deep, and the one of them was $110,000 over asking, and they didn't even get into the negotiation. They just lost.
Wow.
So I felt good to be able to help with them with that. I mean, and that's just one more reputation, and that phone call to the listing agent helped. And that listing agent and I aren't like good friends or anything. We've just encountered each other in the past, and thankfully perceived me as credible. There's been some others. It's always fun helping first-time buyers, to be honest, because it's satisfying. They're so excited.
Yeah, they're excited.
They're so excited, and they're starting their life together usually, or a lot of single women in their late 20s, early 30s. They're nervous and uncomfortable, and they've got the financial horsepower and the savings and good guidance. They respect that, and helping them avoid different little pitfalls and how to do everything in an efficient way, and explaining things and just looking out for them. First time buyers and solo buyers, couples and solo buyers, like it's just very satisfying to help those folks.
Yeah, and they're so grateful.
Yeah.
So I agree. Okay, well, thank you for being here today and helping us answer those questions that we get a lot from buyers too. And where can people reach you? Are you on social media? Where's the best way for people to reach you if they have loan questions?
Probably Facebook. My page is fully public, so everybody knows my life story. You can obviously Geoff Black with Guild Mortgage. If you search that on the web, I come up at the top of the search. Of course,
and it's Geoff.
Yeah, Geoff with a G, because my parents wanted me to be top when I was in high school. Anyway, of course, Jenica, you can put us in touch.
Yes.
I appreciate that. But that's it.
Okay. Well, thanks for being here.
I come up all over the internet.
Perfect. Okay. Well, thank you for being here. We'll share all this info in the comments and everything. So have a good day.
Thanks, Jenica. I appreciate it.
Bye.
Bye.